SBI, Bank of Baroda, Canara Bank, ICICI, HDFC, Axis Bank, and several other lenders have hiked their deposit rates to attract funds. It comes at a time when growth in bank loans has surpassed deposits. SBI has launched a 75-day Utsav deposit scheme, which is offering 6.10% for fixed deposits. Senior citizens will get an additional 0.50%. The offer is available till 30th of October. Bank of Baroda has announced its Baroda Tiranga deposit scheme. Under it, deposits are available in two buckets. One offers 5.75% per annum for 444 days and another offers 6% for 555 days. The scheme is available till the 31st of December. It is for retail deposits below 2 crore rupees. Senior citizens will get an additional 0.5%. Non-callable deposits will get an additional 0.15%. Canara Bank has also launched a 666-day deposit scheme offering 6%. After the Reserve Bank of India's move to hike the repo rate by 50 basis points on the 5th of August, a number of lenders have raised fixed deposit rates in various maturities. Experts had said that while FD rates had risen, the pace had been slow. Overall, the transmission of repo rate increase to FDs has been much slower than the transmission to lending rates. So, given the situation, will the rate increases be enough to benefit investors with FDs? Also, will the higher FD rates lure away equity market investors?
So a couple of points here. First is that fixed deposits always struggle to beat inflation, and that's something we have seen across the board, right? So rates are rising, but rates are rising because interest rates are also rising, right? So inflation is also rising. So that's not uncommon. It keeps happening all the time. So if you are betting on FD increase in FD rates to beat inflation, you are banking on a lot of luck, which may not come your way, right? So I think for that, again, it's a different topic, but I think you might need to look at some of the growth assets in your portfolio. Now, for somebody who has to make a choice between a bank FD and, let's say, a riskier product, let's say stocks or equity markets, like equity mutual funds, I think a lot would depend on their outlook and, of course, their recent experience. So I don't think FD rates are that attractive at this point in time where people will start, moving out of their stock market investments. FD rates are between 5.5 to 6.57%. These are not very, very, very lucrative, right? So unless somebody has had a bad experience in the markets and they want to move out of the equity markets in general, or unless somebody feels that equity markets are stretched at this point in time and let me save some money, I don't think people will suddenly start taking out money from equity markets simply because FD interest rates have gone up by, say, 0.51%.
The 3 consecutive rate hikes mean further momentum for rising fixed deposit interest rates. Clearly, the era of extremely low FD rates is over. Still, avoid excessive reliance on FDs. When one accounts for both inflation and tax, returns from bank FDs are negative. However, you can opt for FDs for short-term capital protection, for example, for parking emergency funds. The benchmark repo rate now stands at 5.4%. Cumulatively, the central bank has hiked the repo rate by 140 bps in this cycle. Going ahead, most economists expect it to rise to 5.75 to 6% by the end of this calendar year. So, how should fixed deposit investors calibrate their strategies? If you are starting with FDs now, you should opt for shorter tenures. Why? So that you can roll them over into higher rate deposits when the former mature. According to experts, you should also avoid the auto renewal facility. That will allow you to renew your FDs at the best rates after taking into consideration your investment horizon and the highest available slab rate. Experts also say that you should create a ladder of maturities. Basically, invest in FDs maturing at different times. Doing so will minimize the risk of reinvestment. Also, a laddering strategy will ensure cash flows at regular intervals.
The second point is if your premise is that the interest rates are going to go up, now that's the premise. We don't know if that will happen or how that will happen, what will be the pace of all this, what will be the trajectory. But if as investors you feel that interest rates are going to go up, I think then you must open shorter term duration FDs, right? So let's say instead of opening 5-year FD, you might want to open just 1-year FD, right? So look at the maturity points and the interest rates on the FD rates that the banks are offering you for those maturity points. It's possible for 6-month FD you are getting 4.5%. For 1-year FD you're getting 5.5%. For 2-year FD you're getting again 5.75%, right? Now the difference between 6-month and 1-year FD is about 1%, 100 basis points. Between 1-year and 2-year is 0.25%. In that case, if the premise is that rates are going to go up, you can look at shorter duration FDs instead of longer duration FDs.
Remember, guessing the best time to opt for long-term FDs is a risky proposition. You might think that interest rates have peaked, but they could increase further.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.